Is that the government or is it the Chinese government working with JPMorgan saying, give us the metal? Could be both.
Is there any concern in the silver world that you can detect from graphene eventually becoming a replacement for silver in all the commercial things that silver is used for right now for conductivity reasons?
Is it coincidence that Trump reclassified silver as a critical mineral? I don't know. The Dutch bank, Austrian bank, the Czech bank, the Polish bank, the Bank of Hungary, Turkey, they all said the same thing, give us back our gold, from the Bank of England and New York Fed in 2017 when no one was buying gold. There was Tesla and Samsung and Sony, but even still, why not just leave it in the vault and take it when you need it? And that's why you see them build that $4 billion smelter as well. It's not just precious metal, it's rare earths as well. They refine pretty damn close to 100% of all the rare earths. This is national security. China came out and said, listen, you know, we're the second largest producer of silver in the world. If you ask JPMorgan, he would tell you, he was told when he went to China and visited some mines, they said, we're number one, not number two. But physical possession and physical accumulation is worth more than the dollars that are valuing it.
First off, just real quick, if this is the average baseline for CME margins for precious metals, and they went up to some, extreme to cool off the froth, where are they now? Are they back to normal, or are they somewhere in the middle?
They're more in the middle. They're not back to normal, but they are lowering them to get more speculation. That's one of the things that always blew my mind about the way the system worked. I mean, it was rinse, wash, and repeat, and the commercial banks would suck in the speculators, whether it be through having virtually no margin requirements or very low margin requirements or letting the price rise, suck in the speculation, sell all of the options. They knew where the expiration dates were. They knew where the pain points were, and they would smack it leading into options expiration. The options would expire worthless. The big managed money that played this game rarely won. Maybe they'd give them a token win now and again to, give them the taste of victory and we can do this. And then bang, they would just pickpocket them every time and it would start the process all over again. At some point, you're like, well, why don't they just stop participating in this game? Don't get in there and speculate. Don't give the commercial banks the ability to do this to you.
Right.
And when you see this record low open interest right now, where open interest is very low, meaning the contracts that are purchased by the speculators, by the managed money, the hedge funds, whatnot, it's very low.
When margin rules quietly loosen, it's rarely about helping traders. It's about restarting the casino. As Andy Schectman points out here, precious metals margins were pushed higher to cool speculation, and now they're drifting back down just enough to pull traders back in. Historically, this rinse and repeat cycle lets large banks sell options and pressure prices around expiration, while leveraged funds absorb the losses. The tell today is record low open interest, meaning many speculators already stepped away from the table. Next, Andy Schectman discusses why the system may now be trying to lure them back in again.
So let's lower rates more, margin rates more, maybe we can suck them in. It's kind of the thought. Maybe some of these traders are finally waking up to the fact that this is a game very difficult to win at that level. It's one thing to hedge your exposure. It's another thing to bet against or with or against what the price is going to be. And I think that's one of the reasons you're seeing them try to lower rates. But they haven't gone all the way back down yet, but they've certainly come down considerably.
Okay. And, Andy, when you talk about things like 38 million ounces withdrawn, right? We've talked about this before, like, my mind just goes to, like, where is that going? Who's got the capacity to store that amount?
That's why you are who you are. But that's why you are who you are, because those are the things that matter, right? Who is taking it? A mint box of Silver Eagles weighs 42 pounds. It's 500 ounces. So who in God's green earth took almost 39 million ounces? It's over 2 million pounds. Well, who's taking it? How many trucks does it take to move that? Where's it going? Who's going to take possession of it? And can you imagine trying to unload that? It would take you all day with a whole group of vault attendants. But not only that, is it insured? Who's going to do that? These are all very, very, very important questions to ask.
38 million ounces leaving vaults sounds abstract until you picture literal truckloads of metal disappearing. As Andy Schectman points out here, lowering margin rates may be an attempt to drag speculators back into futures markets. But the more revealing signal is the scale of physical withdrawals. Nearly 39 million ounces equals over 2 million pounds of silver. Logistically massive, insured, transported, and stored somewhere by someone with deep infrastructure. That kind of movement rarely comes from retail traders or hedge funds chasing momentum. Next, Andy Schectman discusses who might realistically be capable of moving metal on that scale.
And it all comes back to someone who knows where the puck is going and has the ability to do this, where cost isn't even an issue. And that's the thing, is that rhetoric and seeing what they're really doing are detached. The rhetoric would, would tell you, the price, big outflows out of GLD. Yeah, no one wants gold anymore. You got massive outflows of GLD. Well, what do you mean outflows? That's the same thing as share redemption, because the price didn't drop by those big outflows.
Right.
They're using every single trick in the book, in my mind, to take physical possession in a very private, clandestine manner, so as not to raise awareness. So yeah, who is taking it? People who are very sophisticated, people who are very wealthy and have the ability to not only run logistics and insurance, but to your point, store it in a meaningful way. That's why I think it's the Exchange Stabilization Fund. Who could do this?
That's why you think it's governments, behind it.
Yes, because the Exchange Stabilization Fund can do these things if for national security. A critical mineral, by definition, is for national security. Shh, don't tell. I think that's what they're doing. Either that or it's Tesla and Samsung and Sony. But even still, why not just leave it in the vault and take it when you need it? And maybe some of that stuff that stays in the system are legitimate, manufacturing companies.
ETF outflows often sound bearish, but the plumbing of the market tells a very different story. As Andy Schectman points out here, when gold leaves vehicles like GLD through share redemptions without crushing the price, it usually means large players are quietly converting paper claims into physical metal. That kind of operation requires logistics, insurance, and vault capacity that only governments, sovereign funds, or mega corporations typically control. In markets where rhetoric says demand is fading, the actual behavior may show strategic accumulation instead. Next, Andy Schectman unravels why government entities could be central to this quiet shift.
But when it leaves, well, that's a whole different, ball of wax in and of itself.
Okay. When it's being withdrawn from the COMEX, that's happening here in the US, right? But it doesn't mean those ounces stay in the US, right? So it could be the Exchange Stabilization Fund, it could be the US government storing this stuff in Fort Knox or under a mountain or something like that. But presumably it could be a foreign government taking delivery and then just putting it on a cargo plane and flying it to their country, correct?
Absolutely. Absolutely it could be. Now, we don't really know. That's one of the great mysteries. I think, we have to try and put all the dots together best we can. But when you see these deliveries for 16 straight months, when you see large outflow and then realize, is it coincidence that Trump reclassified silver as a critical mineral? I don't know. You tell me. And I often go back to what the BIS did, where the Bundesbank said, give us back our gold. I've talked with you about this before. All of the central banks associated, the Dutch bank, Austrian bank, the Czech bank, the Polish bank, the Bank of Hungary, Turkey, they all said the same thing, give us back our gold, from the Bank of England, the New York Fed in 2017, when no one was buying gold.
Metal leaving an exchange vault doesn't just disappear. It usually signals a strategic decision somewhere in the system. As Andy Schectman points out here, COMEX withdrawals don't guarantee the metal stays in the United States. Sovereign buyers could easily fly those bars to their own reserves. The deeper pattern investors should notice is timing. 16 straight months of deliveries alongside policy shifts, like the critical mineral classification of silver. History shows central banks repatriated gold in 2017 before the major buying surge of 2018 to 2019. Next, Andy Schectman talks about how these policy signals may reveal where the real accumulation is happening.
In fact, they'd all been selling it. 2018, that number, those same countries bought more gold as a group than they did in the 60 years previously combined. Then they doubled that number in 2019, and then magically the BIS says, by the way, gold is now tier 1. If you think that's coincidental, I guess what I'm getting at is at that level, these big players not only strategize, but they take care of their own and tell them what to do well ahead of time. And so when you see this anomaly of deliveries in silver and in gold into the United States, and then you see things like this, it's leaving and it's now reclassified, and what Judy Shelton has talked about, at some point you have to understand that that's the only way to get this stuff done, is to front run where it ultimately goes. And you have to try and guess, is that the government or is it the Chinese government working with JPMorgan saying, give us the metal? Could be both.
Right.
I don't know, but it's certainly very unusual and leads one to start thinking this way as well. Who the heck is doing this?
Got it. Okay. All right. So looking at the time, there are a couple of key points I still want to get in before we wrap up, but we'll just chomp our way through it.
Adam, one last point.
Yeah.
It doesn't matter who the hell is doing it. What it tells you is that the price, the dollar price, isn't the issue.
When central banks quietly flip from sellers to record buyers, markets should ask why the rules suddenly changed. As Andy Schectman points out here, the same countries that spent decades selling gold suddenly bought more in 2018 than in the previous 60 years combined, then doubled that again in 2019 before the BIS reclassified gold as a Tier 1 asset. That sequence raises an uncomfortable question investors rarely hear discussed. Did policy insiders move first while the public narrative lagged behind? Strategic asset shifts rarely happen without advanced coordination. Next, Andy Schectman unravels why the real signal isn't price at all, but who is accumulating physical metal.
It's a physical possession,
Right.
and physical accumulation is worth more than the dollars that are valuing it.
So
Whoever's taking it.
great point, and that's been a common theme throughout my discussions here with you. Is at the end of the day, what matters is possession. Here is at some point in time, when and if the music does stop, it's not going to matter what the price is. It's just going to matter is who's got how many ounces. Yeah,
Correct. That's right.
Okay, so you've talked in the past about how China has I don't know what percentage, but a very large percentage of the world's refining capacity for the precious metals, and that recently it was called an export ban. I don't think it's a 100% blockade of refined metals leaving their country anymore, but they basically said, look, it's going to get harder, or we're going to let less metals that come into our country go back out. The U.S., as I understand it, is really sort of fast tracking precious metals refining here domestically. In your mind, how long will it take for us to be able to ramp that up to any meaningful level where we can start, giving the rest of the world an alternative to having to send their stuff to China?
Markets often obsess over price charts, while the real battle quietly shifts to who controls the underlying assets. As Andy Schectman points out here, the strategic priority appears to be physical possession, not the dollar value attached to it today. That matters because China already dominates a massive share of global refining capacity, meaning supply chains and industrial leverage could hinge on where metals are processed, not just mined. Investors watching geopolitics should note how resource control increasingly mirrors energy politics from the early 2000s. Next, Andy Schectman discusses how refining infrastructure may become the next strategic choke point.
Hopefully pretty soon. That's why you see him build that $4 billion smelter as well. It's not just precious metals, it's rare earths as well. They refine pretty damn close to 100% of all the rare earths as well. And again, this is national security.
And sorry to interrupt, I just don't know. Is it just as easy to refine rare earth minerals as it is precious metals, or is one easier to refine than the other? I get the sense that rare earth refining is a lot tougher, or else we wouldn't be in this pickle that we're in globally versus China. But I could be wrong.
I don't know either, but I will tell you that doré bar, which is the bar, a crudely refined bar that the miners will pull out, China is responsible for refining doré. About 70% was the number that I saw. Between 65 and 70% of the doré bars that are refined are actually refined in Switzerland. And then, in China, and a lot of those bars then would be sent to places like Switzerland to break them down into smaller units and whatnot in places like Argo Herreras or Valcambi or Pampa or whatnot. But they're huge in it. But it's also important to realize that everyone focuses on that. That was kind of the retaliation, if you will, to the United States classifying silver critical. And people forget the European Union did it a year and a half ago, same thing.
A $4 billion smelter isn't just an industrial project. It's a geopolitical signal hiding in plain sight. As Andy Schectman points out here, China already refines nearly all rare earths and roughly 65 to 70% of global door bars before metals even reach Western markets. That means much of the world's supply chain still passes through Chinese refining infrastructure, giving Beijing quiet leverage over pricing, logistics, and downstream manufacturing. Investors focused only on mine production miss the bigger story. Refining is where strategic control actually lives. Next, Andy Schectman shows why this refining dominance reshapes how the West thinks about resource security.
But what people miss is in November, China came out and said, listen, we're the second largest producer of silver in the world. If you ask JPMorgan, he would tell you he was told when he went to China and visited some mines, they said, we're number one, not number two. But wherever it is, they're very, very, very significantly producing silver in their country. And they came out in November and said, listen, the stuff that we mine will be primarily for domestic use. And so you're seeing not only the Chinese not sending any silver out to the world, but they want to reduce and curtail the amount of doré refining that goes out as well. So again, yes, all of this points to a realization that there is a race to having the real thing versus the system that the West set up, which is about paper pricing and creating this, I guess, this distortion of value through the West being able to control the price.
Commodity headlines still treat silver like a tradable asset, but policy signals suggest it's being treated more like strategic infrastructure. As Andy Schectman points out here, China has already signaled that domestically mined silver will increasingly stay inside its own borders rather than flowing into global markets. That decision quietly tightens international supply while challenging the Western system where futures contracts and paper pricing dominate trading. When the world's largest producers prioritize domestic reserves, markets eventually confront a simple truth. Paper liquidity cannot replace physical scarcity. Next, Andy Schectman unravels why this shift could redefine how precious metals are priced globally.
That's ending.
Yeah.
That to me is ultimately ending, is what this is largely about.
Okay. But in terms of sort of the supremacy of the physical ounces, right? Part of the whole Monroe Doctrine 2.0 vision is, we create much more incentive for the Western Hemisphere to trade amongst itself. And as you've said, right now, much of the doré in South America is going to China. We ramp up our our refining capabilities here in the U.S., and we come up with enough trade deals in total that make it worth their while. Presumably, we're trying to make sure that a lot of that South American doré goes north to us now rather than east to China, correct?
Well, and you talk about how the Chinese, I said, look, they think in terms of decades. So, okay, we're reactionary. What have they been doing the last several years? Well, they've been flying to Mexico, to Peru, number 1 and 3 largest producers in the world, China number 2. If you're the number 2 largest producer in the world and everyone sends you your doré bars to refine stuff, and the price has done nothing, then why fly all around South America and to Mexico and say to these countries, listen, we'll pay you double what the West will for your doré and your concentrate.
A quiet commodity war is unfolding far from Wall Street screens. As Andy Schectman points out here, China has been traveling to Mexico and Peru, the world's first and third largest silver producers, offering roughly double Western prices for doré and concentrate, which signals strategic accumulation rather than simple trade. When a nation already controlling huge refining capacity pays premiums while prices stay flat, it suggests the paper price may no longer reflect real scarcity. For investors watching metals, that disconnect raises serious questions about future supply shocks. Next, Andy Schectman discusses why China is willing to overpay just to secure physical silver,
which is a byproduct sludge, and we'll send it back to China and refine it. Why would they do that if silver was just something that didn't matter? They are way ahead of us in thinking this way, way ahead of us. They've been mining gold and silver for years. That was uneconomical using our trade imbalance to do it.
Right.
And now they're like, you know what? We are the first or second largest producer in the world. Let's go to 1 and 3 and get their stuff too. Because we can refine it and we can pay more than the West will because we have more spare cash with this trade imbalance. And it's a good way to de-dollarize at the same time. They're choking on dollars and treasuries. So unload that for things that are tangible that we need. Doesn't matter what the price. It's kind of like the large premium we see in Shanghai right now. And again, you know, I've researched it and dug deep into it, and the VAT tax is the responsibility of the recipient primarily when it leaves the exchange, not the guy delivering it or the company delivering it. And so, yeah, normally arbitrage like we see in Shanghai would disappear quickly. It hasn't. It's like 13% plus the 13% VAT tax. You're talking 25% more they're willing to pay in dollar terms than the Western price truly is, because this is a race for the real thing. More than anything, that's what you can see if you take a step back and say, yeah, that's what they're doing. Price be damned, they don't care. They want to get rid of these dollars slowly instead of dumping them. Buy things that you need, and that silver in their possession is worth way more than the dollars that they use to buy.
When a country willingly pays 25% above global prices, the official market signal stops making sense. As Andy Schectman points out here, Chinese buyers are reportedly absorbing silver at premiums approaching 13% above the Western price, plus another 13% VAT cost in Shanghai, a gap that normally would be arbitraged away within days. The fact that it persists suggests something deeper than trading, a strategic conversion of dollar reserves into hard assets as China quietly reduces exposure to US treasuries. For investors, that behavior signals confidence in metal over currency. Next, Andy Schectman shows why physical silver may be outrunning the paper market.
My question for you, Andy, is just, is there any concern in the silver world that you can detect from graphene eventually becoming a replacement for silver in all the commercial things that silver is used for right now for conductivity reasons?
You know, I spend 3 hours a day, pretty much 7 days a week reading. And while I did come across that story, I have yet to see anything that even begins to show any concern for it. That doesn't mean it's not. And I'm reading everything I can on metals, on economics, on emerging technologies, whatnot. At this point, no, it's still pretty much off the radar, and I don't know. And that, you know, again, I'm not an expert on graphene whatsoever, but I can tell you from what I see, doesn't seem to be really on the forefront of the minds collectively.
So you're not hearing from inside the system, people are worried about this as a threat. And from what I learned, and I'm no expert on graphene, you know, it can't really be commercially produced at scale yet. And that's one of the reasons why this company folks were so excited about it, is they have technology that might eventually allow that. But, you know, we have gazillions of ounces of silver that we can pull out of the earth every year. We don't have that supply yet in graphene. So even if it does do what they say it can do, the supply just isn't there right now. Okay, so let's get to this other major topic. So you referenced, Andy, that as silver was vaulting above $100 an ounce.
Every commodity bull market eventually faces the same question. What if technology replaces the metal entirely? As Andy Schectman points out here, graphene, often cited as a future conductor alternative, simply cannot be produced at commercial scale yet, which keeps it far from threatening silver's industrial demand today. Even if laboratory performance looks promising, global supply chains still rely on billions of ounces of mined silver each year for electronics, solar panels, and medical applications. For investors, the immediate risk isn't substitution, but supply tightness. Next, Andy Schectman unravels how market rules can abruptly slam the brakes on rising metal prices.
And gold gotten up to 5,000 an ounce. The CME started hiking the margin requirements for the precious metals. And that's kind of like pumping the brakes, right? It makes it harder and harder to hedge against these metals. And guys like you, it makes it much more expensive to buy insurance and whatnot. And so it's designed to cool off the froth, right? And we can maybe speculate that it worked, obviously, because the price hit a spike and it's still recovering from then. I think it was a week ago I saw, maybe a little bit longer, but the CME started it increased margins on oil to try to stop the froth in oil prices, but it lowered them in the precious metals. Does that send any sort of sign to you that it might be game back on for the march of the precious metals prices going forward?
Yeah, I mean, it also shows to me that there's record low open interest, that you've knocked out so much of the speculation. It's not just hedging the way that I use it. It is for hedging, but the way a speculator would look at it is, well, geez, because there was that period of time where silver was going up unabated week over week over week. So they would just buy contracts. And it's important to understand that one contract, COMEX, is 5,000 ounces.
Sometimes the biggest market moves happen not through price, but through rule changes. As Andy Schectman points out here, when silver surged toward triple digits and gold approached $5,000, the CME dramatically raised margin requirements, forcing traders to commit far more capital just to hold futures contracts. Historically, this tactic has cooled rallies. Similar moves appeared during past commodity spikes when exchanges feared speculation spiraling out of control. Now margins are quietly easing again, while open interest sits near record lows, suggesting much of the speculative froth has already been flushed out. Next, Andy Schectman discusses how leverage amplified the entire silver rally.
And right, so, again, I'm going back from memory, but sometime in like the beginning of December, to hold a 1 ounce or a one COMEX contract of 5,000 ounces, back then silver was about $60. $300,000 worth of silver would be controlled by, at the time, roughly only $15,000 in your margin account. So about 20 times leverage. By early January, we were up to over $50,000 or thereabouts in your margin account to control the same amount. And so if you are a speculator, forget about if you're a legitimate hedger or, for a producer, for a company like mine, for a refinery, all of those companies who have legitimate hedging concerns face the same consequences, where, if you hold 2 million ounces in your warehouse, like we typically would at 5,000 ounces per contract and $50,000+ margin in your account that just sits there as collateral, you have to have $50 million in your margin account in order to have any type of inventory. That's just silver. Forget about gold and platinum. But if you are a speculator, well, you say, geez, we can control, $300,000 worth of silver, and it keeps going up. Let's buy more. Let's buy more. Let's buy more. The day after Christmas, they jacked rates from by 30%, from 15 to 18,000, and then they did it again and again, and then all of a sudden it's $50,000+. And when they jack up margins, if you don't put that money into your margin account by the end of trading, bang, you're liquidated, and they will close you out. Which selling begets selling, begets selling, begets selling, the price craters. And then the big traders who aren't using margin, they come in and say, thank you very much. We're going to stand for delivery at these subsidized prices.
Leverage can inflate a rally just as quickly as it can destroy it. As Andy Schectman points out here, a COMEX silver contract controlling roughly $300,000 worth of metal once required only about $15,000 in margin, nearly 20 to 1 leverage, before exchanges rapidly lifted requirements above $50,000. When that happens, speculators who cannot post new collateral are automatically liquidated, triggering cascading sale orders that can crush prices in hours. For investors watching from outside futures markets, those crashes often look mysterious, but are largely mechanical.